Hello, everybody. It is Monday, January 27th, and it is quite a day in the stock market today. So, the news out that's roiling the market today is the advent and release of DeepSeek, which is a Chinese alternative to a lot of the artificial intelligence revolution that has taken the market by storm here over the last year. Just a quick Google search of DeepSeek shows that this new AI app sends U.S. tech stocks reeling. It's hit NVIDIA, which has been a leader in the artificial intelligence space. And so the impact that it's had on the stock market, the S&P 500 day is down almost 1.5%. The NASDAQ down over 3%. The Dow managed to gain today. The Russell 2000 small cap index down about 1%. When we look at the difference between large cap growth and value stocks today, pretty shocking there, down almost 3% for growth, but up on the value side. Chad, you and I were talking before we came on here. NVIDIA today down almost 17%, and it shed one of the largest amount of market capitalization in a single session today.
Yeah, that's right. I mean, given its size, right? It's the numbers can add up quickly. So close to 20% decline, has equated to nearly a $600 billion market cap destruction at one point in NVIDIA's stock today. The largest, of course, in history in any one single market.
The amazing thing is that the amount of market cap that NVIDIA shed today is probably larger than the 10th largest stock in the S&P 500, or probably really close to it.
Yep.
And so this news release that's come out about how now there's an alternative in the artificial intelligence space, whether it's the news coming out right now, we have been talking about for a good 6 months how the market has become very concentrated in these large cap US growth stocks. They're mostly in the technology side. We wrote a white paper in the summer of last year where we were encouraging people to remain diversified, and that when we get into these historical scenarios where the weight and the concentration within the S&P 500 is highly leveraged to just a handful of names, that's really only happened in periods of excess, in periods of bubbles. As of last summer, 36% of the S&P was comprised by the 10 largest names. It was only 25 back during the tech bubble. And so we've been talking about how the market has gotten to be very expensive, really just concentrated in a handful of names.
Right.
And that's something that we believe that people should be on guard against. They don't want to be overly exposed to that. You were recently reading this missive from Smead Capital where they were talking about something kind of similar. What they said, the 5 largest stocks in the S&P as of the end of last year, 28.8%. And we've never seen that before in history.
Right. Absolutely. Yeah. So we want to give credit to Smead Capital. There's some great folks over there and smart analysts. But yeah, this missive we were reading was really aligning with our view of the market. Again, remember, our role and our objective with how we manage money for clients is to utilize our discipline to align with market trends. But we do this analysis of the broader market, to provide context, to understand what's driving the market, and really to look at vulnerabilities, right? So we have known now for a long time as we've done this analysis that the market was extremely concentrated. And this chart here illustrates that, right? Far beyond what it was at the last extreme level that existed back in the 1960s. Of course, that resulted in a change in that cycle. And then also this valuation composite that they put over here, which is similar to what we have shown clients and folks for a while now, but this is what's neat, is this is a composite of many or multiple valuation metrics. So this is taking price to earnings, price to sales, price to book value, and price to dividend. And instead of looking at any one of those in isolation, it's a composite of all of them. And what this reveals is what we've been saying for a long time, and is that the market, especially the S&P, driven by this handful of concentrated stocks, is at an all-time high valuation historically that is beyond where the peak was at the height of the internet bubble, beyond where the peak was just before the COVID crash. And again, doesn't mean that it can't continue, but it means be aware of the vulnerabilities that may exist, the thin ice that we're on in the market. And today, is a great example. We're kind of calling this is this a shot across the bow for the NASDAQ or for the big cap tech names? Because when something like this comes along, it could be the catalyst that then finally causes people to wake up and say, hey, wait, why are we paying so much for these companies like NVIDIA when all of a sudden tomorrow in this technology arena, new tech can come along that can be made quicker and cheaper and maybe
Yep.
calls into question the earnings projections that are out there, et cetera.
Correct. Yeah. And we're not just picking on NVIDIA or any company in particular, right? But we saw, ARM
Right.
Holdings, right, down over 10% today. Taiwan Semiconductor down 13% today. Lam Research, probably a similar, the entire semiconductor
Yeah.
space today really
Broadcom,
got sold
AV.
off into this idea. I know you and I have been talking about how these areas have been priced for perfection.
Yes.
And the one analogy that I want to draw is really back to this dot-com bubble timeframe where um, we had at the height of the internet bubble, you had the companies out there like Cisco and Nortel Networks and Juniper that were making the
Mm-hmm.
chips, they were making processors, they were making switches. The internet was going to change the world, and it certainly has. But the ironclad laws of economics tell us that if there is a profit to be made somewhere, there's going to be competition.
Oh,
And you're
yeah.
going to have competition that comes in that makes a better widget for less money. And that's really what this DeepSeek coming out of China is really the first shot across the bow there. That they
Mm-hmm.
are allegedly, they have come up with a system, maybe the hardware that's going to be able to produce really good results for a fraction of the cost. And if
Mm-hmm.
all of a sudden that's going to undermine NVIDIA's ability to be able to sell what they have at this premium price, that was the first thing that happened during the dot-com bubble. And then it was a race to the bottom for these
Yep.
companies. They could sell their chips for less and less. But the other thing, and I don't think it's been talked about yet, is that the speed of technology would suggest that these chips that they could be obsolete maybe in 18 months or something like
Sure.
that.
Yep.
And so now the inventory that they have of even these new AI chips that are incredibly expensive, that in 18 months, maybe they're obsolete and they're having to write down the value of any inventory they had. It's the exact same story that we saw during the dot-com bubble.
Yeah.
And so the
Absolutely.
one thing that I know we've been very focused on telling our clients is that when you have markets that are very expensive, right? This is just another look at this is from the JP Morgan Guide to the Markets, that when you get markets that are in the upper echelons of valuation,
Mm-hmm.
that your forward returns, right? This is the 5-year annualized forward return for the S&P with these various starting valuations. They're not good,
That's right.
right? And
Yep.
when the markets are this expensive, and and I think that a lot of investors unwittingly are overexposed to a lot of these names, and they think they're diversified, maybe because they're in the S&P 500, or maybe they've
Mm-hmm.
just been trying to chase where the growth is. But days like today kind of comes back and shows them that you've got a lot more risk in your portfolio than you thought.
Right. Absolutely. And so it reinforces the reason why diversification, still our are very prevalent, right? There's merit to the concept of being broadly diversified. For us, that means, structurally diversified, but only when things are in uptrends to be exposed to those areas of the market. But still, the primary tenet of diversification still holds true. And when you're in this late stage of a cycle like we're in, of this dominance in one asset class, it spurs, or it kind of breeds and cultivates complacency. People get caught up and into this expectation of this area that's dominated is going to continue to dominate. That recency bias, right? It's going to continue on, and oh my gosh, I got to really jump in there and hop in and not miss out, right? The FOMO takes over and all that, and so that's why we reinforce these concepts, and yet try to bring to light for people the data that supports the logical, prudent approach to the market, and looking for where there's opportunity, looking for where the cycle may shift and other areas can do well and take over. And, today was an interesting day because a lot of the areas that we've been focused on in the market did well today. These under the radar, under the surface, value-oriented, quality-oriented, dividend-yielding-oriented types of stocks actually managed to do well and actually went up today in many areas. So, is this the beginning of what we thought may eventually unfold? We don't know yet, but this is the kind of catalyst that can bring about a cycle change.
Sure. Well, and we see that it's unfolding at kind of a very logical level.
Yeah.
And the expectation that investors need to have is that the areas that have gotten very expensive by any of these combination of fundamental valuation metrics, that the expected forward returns there really are below average, and in many cases are below zero. But I think you really hit on it. It's the psychological piece that is so hard for investors to try to shy away from these areas, and they feel like that they're missing out. It feels like it's a no-brainer to be exposed to these things. And for all of the great logic that one would have had to look for the more undervalued securities, they haven't performed great, in the last 12 to 18 months.
Right.
And people are at the point where they're trying to throw up their hands and say, I just got to get into these other names. And it just seems like it could be not the right time to be doing that, that this reversal, maybe this is that shot across the bow. It's the catalyst, the real change.
Yeah.
To where we see that continued rotation.
Yep. Well, it's a good discussion and appropriate for us to be looking closely and keeping a keen eye to these changes in the market environment and being aware of them to protect against the wrong exposures, and to be focused on risk management for folks we work with. So with that, you want to wrap it up there, I guess?
Yeah, I think we can wrap it up. This is obviously going to be an evolving thing. We want to see, what happens, what unfolds here in the coming weeks, in the coming months. But big market moving event today that we think is worth talking about with everybody. So everybody, please stay tuned to our social media, to our monthly updates, where we want to continue to bring you the evolution of this story. But as always, be mindful of what you own. And we will talk to you next time.